And with that, everybody, hello. This is Darren Kelly, and I'm pleased to be here with you guys today for this webinar coming from my beautiful home office in Boulder, Colorado. Today's an exciting day for us who think about social media and think about trading. I'm here to moderate this webinar with a team from OptiRisk. OptiRisk Trading Systems has been around for a long time and is headed up by Gautam Mitra. We call him Professor because he's got a long academic career. And the topic of the day is to discuss how OptiRisk has built trading systems that leverage the emerging social media that has exploded in the last couple of weeks and couple of months here in Wall Street. My background started in Wall Street trading in social media nearly 20 years ago with the rise of message boards and the first user-generated content that caught people's interest in and around the trading world. And it was hard data to understand. It was hard to collect. It was hard to synthesize into things that could be used in a trading environment. And luckily, fast forward in the last 20 years, teams like OptiRisk have built fascinating tools to get through the noise and figure out what's actually going on and what's important in social media. And so I'll do some introductions of the team from OptiRisk. We have 3 folks who will present today on parts of their research, and I hope that we'll have some questions after at the end. So to start, I'll introduce Gautam and his team. So Gautam, as I said, is a professor at UCL, and he's been prolific in publishing numerous books, hundreds of articles in this area. Shadra is a data scientist on the team. Shadra, she has got many years experience as a data scientist and researcher, very adept at type of analytical tools that are required to dig through this type of information. And Dhruv will be coming in part 3 or 4. He also is a data scientist, has specialization in the blockchain area. He's got a number of degrees, which I'm sure make his family also very proud. So we're looking forward to hearing from the full research team here. So with that, I think I'll start and say, Gautam, maybe you could give us a bit of an overview of, what is your intellectual property that you're using to build these tools, and what is your value proposition and your unique selling point for the products that you're bringing to market?
Hi, Darren. Thank you for your glowing introduction to our company and our frontline team. To the participants who are here, I would like to introduce OptiRisk as a specialist fintech financial company. We are small, niche, but we are present in multiple geographies. We have persons working from home, WFH, in the east as far as China, then to Kazakhstan, India, of course in UK, in Europe, and as far west as Brazil. We are simply interested in talent, which is why we go to these places. And we focus AI and machine learning and quant methods entirely for the fintech markets and fintech industry. We used to be big in optimization, but now we have chosen to be even narrower, and we work in the financial technology. With these words and short introduction to OptiRisk, I would like to set the scene. I promise we are going to speak about the latest development in AI and machine learning, but also point out what differentiates us. And as I was saying, the AI and machine learning will be focused entirely in finance. And So we believe predicting the market direction is key to creating winning trading strategies. So we present 3 strategies which use AI and machine learning and data science models for prediction. The first strategy we call strategy 1, gap up or down. That is, at the end of the day, we look just before closing, say 30 minutes before closing. We predict next day's market opening direction, and just after opening, around 10 to 11 o'clock, or comparable an hour later than the opening time in different markets. Then our strategy 2 is about multi-asset trading, multiple assets of the constituents of the index, plus uses gold futures, because we are interested in having those assets which may not correlate with how the constituents of the market or the overall market moves. The third strategy is one of systematic trading of VIX and E-mini. We introduce innovation for the first 2 strategies. It uses a behavioral approach of loss aversion, that we want to avoid loss whenever we can, even the prospects of making gains is high. So with these words, let me pass on back to Darren, because he has questions for my next colleague, for my teammate and colleague, Shraddha, who is going to talk about gap up and gap down strategy. Thank you.
Okay, great. Thank you, Gautam. That is very interesting. Thanks for sharing that. Let's now move and hear about OptiRisk's gap strategy. And that's going to be brought to us by Shraddha. Shraddha, take it away.
Thank you, Darren, for the introduction. Hello, everyone. Thank you for joining us for the webinar. I'm Shraddha Berry, and I'll take you through our first strategy, which is the gap up, gap down strategy. So the objective of the strategy, as the name suggests, we try to exploit the gap in the market. So by gap, we mean the difference between the close price and the opening price the next day. So that's the strategy. It's a simple strategy which relies very heavily on our prediction models. The strategy is simple and it can be traded on basically any index that has liquid futures. Right now, our backtests and live trading are being done in Nifty 50 and E-minis, which is SP 500 futures. And to explain the prediction and the strategy, which is like the logic, so the flow goes as such that we run our prediction models, more than one, before the market closes, say about 30 minutes before the market closes, and the prediction is for the direction of the market the next day. So the prediction is basically an up or a down. So it's a classification problem for us. And based on the predictions of all the various models that we have, and also the human judgment, by human judgment, I mean experts in the market who give their general view of how the market is going. Based on an ensemble of all these predictions, we take a call. We either go long, short, or we stay in cash. Now, the reason we do this is for loss aversion. Now, the strategy is a loss aversion strategy, and by that I mean our main objective is to avoid loss. So because we have multiple models and we have a human judgment component, we only take a trade when all our different inputs, the models, the human judgment, all of them agree. So in that case, whenever we take a trade in the market, we are very confident about a win. And the days we are not confident, when we have a conflict between the different inputs, we stay in cash. We don't take a trade, which is why this is a loss aversion strategy. And our objective in this strategy is to have our P&L graph to be monotone increasing. And like I said in the beginning, we take a position 30 minutes, about 30 minutes before the market closes. The position can be long, short, or stay in cash. We go long when all our prediction models and human judgment indicate that the market is going to open up tomorrow compared to the current price, which is the closing price. We go short when the models and human judgment say that the market is going to go down tomorrow. And if they don't agree, we stay in cash. And then we liquidate our position the next morning, say around 11, like Prof. Mitra mentioned in his talk. And moving to the models, we have more than one. We have models like the logistic regression, which is polynomial logistic regression. We have decision tree family of models ranging from random forests to gradient boosts to extreme gradient boosts, which is XGBoost. We have neural network family of models, the ANN deep neural networks and the more advanced LSTM. We also have support vector machines and hidden Markov models. So we have a number of models. We work extensively on different prediction models and we choose the best ones for the strategy. And like I said, there's always more than one model that we use for any strategy. The data that these models use range from market data, various technical indicators, news data, microblogs data. So we have a variety of features that we use to train our models. And the objective is something like this. This is our backtest results on Nifty 50. So here the logic we've used with the prediction ensemble is we had four prediction models, and we took a trade whenever at least 3 of our models agreed. And if that was not the case, we stayed in cash. The graph here, the blue line is our portfolio, and the red line is the index. This is from June 2019 to end of January. This is with leverage of 5. If you look at the statistics, the most interesting part are the last 3, the win days, the loss days, and the no loss days. So this no loss days is something that we've introduced in our summary statistics because it's a loss aversion strategy. Here, what we mean by no loss days are the days we did not take trades because we were not sure, and this potentially helped us avoid losses. So if you compare between the index, which is the top row, and our portfolio, which is the bottom row, we have fewer win days, but again, we also have fewer loss days, and that is the objective. And the beauty of this strategy is that based on an investor's appetite, we can go even more conservative. So this backtest result uses the same model, the same 4 models, but we only take a trade when all of our models agree. So you will see long horizontal lines, which is when the models were not agreeing and we did not take a trade, we stayed in cash. So this graph avoids the quite a few dips that were there in the previous one, and it is more conservative. The returns are a bit lower, definitely higher than the index still, but a bit lower than the previous one. We have many more no loss days, but the loss days have gone incredibly low, which is the objective that we wanted to achieve here. So like I said, depending on our appetite, this model can go from being aggressive to highly conservative. And we are also trading live on the strategy in Nifty. And this is our graph from October 2020 to very current, 16th of March 2021. We're doing better than the index, even though the index has been on an increase, on a good roll during this time. We are beating the index, and we've had 57 no loss days where we've not taken a trade. So we avoided some big dips that the index took. We had a few loss days. Our objective is to always decrease the loss days, but we also had quite a few win days. And usually this strategy, whenever it makes a loss, within the next few days, it recovers the loss. So it's a loss aversion strategy like I started with. And this strategy is also on TRADETRON. Now, TRADETRON is a it's a platform for retail investors. And our strategy is in their marketplace. So we have around 100 subscribers to this strategy, and more than 10 people live trading on it. And this is our stats. We have it from December 2020. So in 4 months, we have a PNL of 71.7k rupees, and the capital investment here is 300k rupees. Our PNL has always been in positive through the entire period. And finally, SP500. So we've already seen the success of this strategy in Nifty 50, and we are now backtesting it for SP500. So before starting with SP500, we thought, should we do it? So we did a very simple math calculation where we compared the returns in Nifty and the returns in SP500, the absolute returns, overnight returns, I mean, scaled to their index prices. And this is what we get. So the blue one is Nifty 50 and the orange is SP500. So looking at this graph, we can easily say that SP500 on the strategy would do equally well as Nifty, if not better, because there are some spikes in SP500 when Nifty's returns are not so good. And the other reason why we think this is going to work well for SP500 is because there is a constraint of lot size in Nifty futures. So one lot is 75 contracts in Nifty, which counts up to a big investment value. But SP500 provides smaller lot sizes. So if we go to E-mini, it's just 50 contracts. And then even if that's too big, we can always trade with E-micro, which is just 5 contracts. So this strategy is going to work well with SP500, even for smaller investment values. So the strategy in SP500 is currently in backtest phase for us, but we are very confident it's going to work well. That's it from me. I'm going to hand back to Darren now. Thank you, everyone.
Well, thank you, Shadra. That is very interesting. Now, if we can move on to the second strategy, I understand that that involves daily trading, multiple assets, and I think Dhruv is going to walk us through that. So Dhruv, it's all yours.
Thanks, Darren, for the introduction, and I'll be taking over from this point, and I'll be discussing about how we are using AIML models and the prediction from them, and how we are exploiting the AIML models in multi-asset strategies for Nifty 50 and SP500 and VIX and all. Okay. So I'll be talking about strategy 2, which is a multi-asset strategy. There's a strategy 1 was about index futures and how we are using AIML for index futures only. But in this strategy, we are using different models which predict close to close, and we are leveraging the prediction from the model for a multi-asset portfolio. Okay. So the objective of the strategy is we will be trading in multiple assets, unlike strategy 1 where we were trading in just index futures. And portfolio is rebalanced in this particular strategy. Portfolio is rebalanced 30 minutes before the market closes. So we enter the market, or we take the position, or we execute the trades 30 minutes before the market. And the assets traded in this particular strategy is index and its constituents. So it's index futures and its constituents. For example, if it's Nifty 50, then Nifty 50 futures and the Nifty 50 constituents and their futures basically. And with the index and their constituents, we are using gold futures in Nifty 50. But in SP 500, it's just about SP 500 futures, which could be E-mini or E-micro, and the SP 500 constituents. Okay. Next is prediction and strategy. So how exactly this strategy works is we get predictions from our quant and ML models. They predict from like today's close to next day's close whether market will be up or down respective to today's close. So they predict it could be up or down or flat. Okay. And we take trades according to the prediction of these ensemble of models and their predictions. So according to the prediction from these models, we can go long only or long short, or either we remain in cash. So how do we decide about going long and long short and cash is, if our model says up, we go long only. There will be 0% shorting. If our model says down, we keep 35% shorting and 35% shorting and 65% long. If our models are unsure, like they are conflicting with each other, they don't have prediction in one particular direction, then we remain in cash. Okay. So that's the strategy. And okay. Now the second thing is how do we decide the asset? How do we pick the assets, and how much assets we want to pick, right? We have decided we want to go long or long short, or want to remain flat based on the model predictions. Now what assets to choose and how much of them we need to choose is decided by SSD, which is Optiris proprietary or optimization model. So it basically assigns weight to the portfolio constituents. Okay, so but before that, what we do, we use filters. So what filters do, they basically divide the constituents into long beans and short beans. So now filters can be based on many things. So one filter which we use is DRSI. But before coming to DRSI, like how DRSI is derived for us is, first we all know what is RSI. RSI is like if 70% is greater than 70%, then it means an asset is overbought and it should be in the short bin. If RSI is less than 30, it means it's oversold and it should be in the long bin. Similar to RSI, we created a filter called News RSI, which is based on news sentiment scores of the constituents of the index. Okay, and then we created another index which is called DRSI, which is derived RSI, which is a combination of RSI and News RSI. So what DRSI is, theta into RSI plus 1 minus theta into NRSI. So it's a combination of RSI and NRSI, and theta can be between 0 and 1. Like if we keep theta at 0, it will be NRSI purely. If we keep theta at 1, it will be RSI purely. So we keep theta something between 0 and 1, and it's a derived RSI kind of. Okay. Now about the now we have the long beans and short beans for the companies and the constituents. We feed this bean to SSD, which basically optimizes and assign weights to the these companies and from the long bin and a short bin. But now this SSD works on a lot of model constraints which we use to to create a strategy, and there are many parameters which we can control. For example, how much money management you want to keep it for margin call or mark to market, what news relevance we want to pick when we are picking the news for when we are picking the news for the constituents, right? And one of the most important parameter is cardinality constraint. How many assets we want in our portfolio. So in this particular strategy, we have kept the maximum number of assets at 15. We don't want to trade in more than 15 assets. So this is one of the constraints which we have kept. I'll be showing in shortly in next slide what are all the constraints, and I'll be explaining them. Okay. So these are all the control parameters. There are many other, but these are the most relevant one. So we have here we have the long and short proportion. Since this is a switching strategy, we are switching between long short and cash or flat based on the model predictions. It varies. Okay, it can be 0% shorting in long case, or it can be 35% shorting in long short, or it can be 0% long and 0% short in cash. Okay, so that's why it's varying. Gearing is leverage, how much leverage we get from the exchange itself. So we get a lot of so we have this is that. Lot sizing in futures, we have lots, so this is that. And money management, we have kept at 30%. So we have kept 30% of the money from the initial investment aside for margin call or mark to market. And one of the important one here is the SSV rebalancing frequency. We are like how frequently we want to rebalance our portfolio or churn the portfolio, basically based on the prediction, or how frequently we make the changes in the company. Okay, so it's 1 day. Basically we are rebalancing the portfolio every day. And the extra assets we are using here is futures with gold futures, like as in index futures and its constituent futures and gold futures. Okay, and again, the cardinality constraints, as I explained in the earlier slide, is maximum is kept at 15 and minimum is at 0. Since in case of we decide to remain in cash, there'll be no assets in our portfolio at that time. Okay, and this is the back test looks like from June 2019 to January 2021, which is around what you can say 1.5 year round. And these are the performance figures. So during this period in June 2019 till January 2021, the strategy is based on DRSI filter. As I explained in the first slide, what is DRSI, and we use a theta to derive DRSI from RSI and news RSI, and here we have kept theta is 0.6. So 60% RSI and 40% news RSI. Okay, and the performance of our strategy and the index is as you can see, index was around 1.16. It went up. The final value was 1.16, around 16% up, and our portfolio was around 40% up during the same period. So, and you can see the maximum drawdown because of the switching between and using AIML predictions from the model. Our drawdowns are really less, which is just 12% compared to 38% of the index, which is like one third, almost one third of the index. And yeah, so yeah, that's pretty much it. So these are the performance figures. So this is our strategy 2 about using AIML in index futures and its constituents with gold futures. Now I would like to invite Darren again to transition us to the next bit of the webinar. Thank you.
All right, thank you, Dhruv. That is very promising. I understand that gold is highly sought after in towns and villages of India. So gold futures as an additional asset makes a lot of sense. So let's wrap it up now by hearing from the professor himself and dig in a little bit about the SYS and VIX-E-MINI strategy. So Gautam, if you want to take it away from here.
Thank you, Darren. You have handed over the baton to me. The last phase of the relay, as if we are doing a relay race. As I mentioned at the start, we will share our USP as well as the innovation that we have done. So why we call it SYS-VIX-E-MINI? Because SYS stands for systematic trading. VIX is for futures contract because it's a highly traded liquid asset. We'll talk more about it. E-mini for SP 500 futures, mini contract, traded contracts. It is an algorithm-driven automatic, that is systematic trading strategy, which trades using VIX, E-mini, and cash. Why VIX? In 2009, we published a paper with Dan Di Bartolomeo and Leela Mitra. It was about improving results of risk computation by employed vol that was done by Dan, and we improved it using news sentiment. So that gave better estimates of covariance matrix and better risk and volatility estimate. Watch is 2009. So our aim was to make ex-ante asset allocation rather than ex-post risk control. So it reflected, because in those days we didn't know that VIX is used for volatility or hedging. VIX contracts are used for hedging. Anyway, we don't use for hedging, we use it for asset allocation. So we discovered VIX. We also explored AI and machine learning for market direction prediction. So only recently, about a year and a half, 2 years back, we have really come up to the scratch on both VIX and with market direction prediction. So it's inspired by AI and ML growth, and also we are smitten by VIX, its various, if you like, properties. So why VIX? Again, you see the option traders provide some information which people have been using for some time. Each asset has got their option traders, and they more or less, whatever happens in the market, news, etc., they take it into account in marking up their options. And so implied fall comes from multiple assets. Or rather, VIX comes from multiple assets, but implied fall of an asset comes from multiple traders. News and media sentiment is added to that in our approach. We use stock tweets, microblog data, news data from various providers like Ravenfact, Thomson Reuters, as well as Alexandria Technology, whichever is convenient for us at any point for the client. Also use various alternative data. Now, recently, or rather in 2018, 2019, there was a paper or article by Financial Times, Robin Wigglesworth, and the modern inventor of VIX, Devesh Shah. And that time, he also talked about a book by financial thriller by Robert Harris using the VIX, the fear index. As you well know, VIX is known as the fear index. So all consummate gambler are attracted by VIX, also the fear index. They use it in different ways to hedge it, but we use it to have asset allocation. Now I'm going to show you a video.
The stocks accelerate their slide down continues demonstrations.
At the nexus of high finance and artificial intelligence, our future will trade on fear. fear index.
Okay, so as you see from the video, it's a thriller, and it also motivated us to explore the scope of combining AI and machine learning and market sentiment as well as VIX. So AI and machine learning we use to predict market directions. And as I said earlier, we are going to deal with S&P 500, VIX, and cash. So S&P 500 index can be up, down, or flat. Also, VIX can be up, down, or flat. Now, the features we use in the model are VIX itself, S&P 500, VIX futures, traded futures, S&P 500 futures, put-call ratio, and many other indicators. The models we use are random forest, hidden Markov model, support vector machine, nonlinear logistic regression. Why do we use so many models? Because we want to look at their ensemble. That which gives the win, if you like, or together when they all point the same direction. Anyway, we create a rules table, which is 3 by 3, because as I said, either S&P 500 as well as VIX can be up, down, or flat, or E-mini can be up, down, and flat. Now, asset allocation we do, meaning how much VIX, how much S&P 500, how much cash, using Optiris proprietary optimization model, SSD, that is second order stochastic dominance. An asset allocation model ensures, this SSD ensures that the tail risk is less short tail and there is upside potential. As you know, symmetric risk index like volatility constrains your upside. So here we go. We can have 3 by 3, 9 times table with 9 cells, VIX up, flat, or down, and S&P 500 up, flat, or down. Now, how we set bounds on long and short position is determined by optimization parameters specified by rules table. The rules table, for instance, for one, gives one set of rules for both being up, another set of rules for both being down, or normally one is up, the other is down, and vice versa. But these can happen as well as in the market. So here are some backtest results following the rules table. So essentially, rules tables tell us what to do next, depending on what of the positions we get, and then we use SSD to find out how much. So this is the backtest, and we are going to show you backtest from June 2019 until January 2021. Also we varied the dates because quite often by varying it, you might get different results. So this is for June 2019, and you can see our figures of Sharps, Fortino, etc., and drawdown and so forth. Days to recovery method. Now, next one is from July, 2nd July. Again, there's some change in the returns, but it's not much, so it is robust. Similarly, so instead of that part, if we go from middle of 2020, how does it behave? We see the next one, where it's from, you can see April 2020 to 2021 January. Again, you see it gives higher return because also during this period, the market has behaved differently. And similarly, from June 2020, no, May 2020, first May, until January 2021. So we believe we are on a good track. We are doing in a few versions, one followed by the other and followed by the other. If I may go back to the video again and the story, what happens in that particular story, they have 3 versions of what they call VIX-E. Their product is called VIX algorithm, and each version is an improvement until a bigger version. And he actually starts trading on the last version beta and gets into difficulty, or rather some interesting situations. So here we are. I don't know, we'll end up with a thriller, but these are our next thing about what next. We do virtual trading. We have been running since October 2020 for 2 separate clients. We're ready to go live now for these clients. They have indicated they are going to do that. We also did some live trading, interesting, some time back, traded profitably earlier between December 2019 and March 2020. Mark the dates. It has been absolutely tumultuous, and also we made very good profit. But in the March 2020, the client said he wanted to stop trading because at the code feed and because of one downturn. And we stopped by their request, but the client is also ready to start again. So we learned a lot from our clients, their appetite for risk, or actually is a behavioral bias of loss aversion, which will be taken into account in future. And as you have seen in the earlier part, we have used it, concept of loss aversion, to have a certain steady growth in our strategies of the portfolio as followed by our strategy. Thank you.
Thank you, Gautam. That is great. That's very interesting. The strategy sounds solid. So I think we're going to have time for questions. So we will now open it up via the chat. And if you want to ask some questions, we'll go to a live Q&A session now.
So we have been getting questions. Can I ask all the presenters to please turn their videos and mics on? We see on screen Gautam, Shraddha, Darren. Dhruv will be here any moment, and Dhruv is here too. We'll start with the first question on screen that's been upvoted already. Why is the prediction short only not considered as model output?
I could start and Prof can come in. So we have been running a lot of prediction models, training a lot of models, and we've always seen that it's comparatively easier to predict up than down. So our accuracies and our stats are better for up predictions, which is why in our backtesting, we are more confident whenever we take up positions. So Prof, you could just add something on that?
Yes, I'm not sure the meaning of the question. Prediction can't be short only. The prediction will be up and down.
Yeah.
So, I mean, there's something strange about this scope. The questionnaire might come back and restate, or the prediction simply says up, down, or flat, as we said. So, let's have this question back. Where will that be?
I'm moving through the questions. Anybody, you could just wave at me or raise your hand or anything, and I'd come to you. It's for all the panelists. The next question is it possible to show the size of the code? At least drop a hint in the number of lines of code. That's coming from Rosh.
That's the tough one, because our codes are like huge projects and there are multiple models, so it's like try to automate as much as possible. So I don't think I have a number in mind, but it's in thousands, I could say. Dhruv,
Most of the time.
What do you think?
You can say, just think of a number like between 30 and 50 and multiplied with 1000 is the number of line of code, and it's partly in R and partly in Python. So I hope that answers your question.
Yeah.
It's not just Python, Roshan. Yes, Professor Mitra.
Yeah. Actually, if you recall, we also mentioned about SSD. That's back in our knowledge of optimization. And SSD, stochastic optimization, we have been steeped in it for many years. And that has, we have the SSD solver, very advanced. So that is at the bottom as well. We have to use that, take that into consideration. So it's a kind of connection of codes which have been connected together, collection of codes which are connected together. And these are each one, if you like, part of it, component is well tested. Or okay.
We're talking here about strategy 2. Is there a reason for going only 35% shots?
I think I can take that question. The reason why we are going 35% shorting is we tested a strategy with different percentage of shorting, like 10%, 12%, 15%, 25%, 75%, and 35% is what is where the sweet spot lies. So yeah, that performed the best. That's why we are at 35%.
Thank you, Dhruv. Are there any charges for using these strategies? Professor Mitra, would you want to go first?
Yeah, we can't just give it away for free. And at the same time, as Sharda showed, that it is already on a platform for retail traders on TRADETRON platform. And similarly, you can use it through a platform, although the other two strategies are as yet not there. But otherwise, if you are an individual, you can approach us. But a company, again, we will make exorbitant charges. At the same time, we need to get a return for what we do and our results. So there are charges, yes.
I saw Darren smiling, listening to the question.
Darren, you better come in when you want to, because you can give your view, overview and all.
Yeah, I was going to answer on the institutional versus retail question,
Yeah.
and I do think that's interesting. I think the answer is both. I do think that this, the trading strategy is boiled down, which is the amazing part. You could get into the raw data, you can get into the code, but you can also just, rely on the model that has been built and simply execute the recommendations each day. And some larger firms, they want to get into the black box. Others, if you're comfortable with it, you can take the signal and trade it. So I feel like you have the ability to go up and down the spectrum there.
Yeah, that's a good question. Actually, on that, if it is good for institution, it's good for retail. The only dividing line between retail and institution is the amount of asset under management, or how much asset they can, or money they can deploy at the start. So, and that's why what Sharda mentioned, that if you do e-micro, you can actually do investment at a lower level, But frankly, it is a question of how much you want to invest.
Right.
Darren nodding his head in agreement takes me to the next question. How long do we virtual trade before live trading? It depends on strategy to strategy, but the next question.
I would just like to add it there.
Yeah,
how long we do the virtual trading until, if you are the client, until you are satisfied to put in your real money, we'll do the virtual trading for you till then.
Yeah, I think that length is dependent on what his client is comfortable with. And actually, what happens after virtual trading, at least major investors would put in a small amount of money to test it in the real life. There is many a slip in the sense that the broker will not give data in time and response back. I mean, there is a lot of problem in terms of automating it. And if you don't automate, it's a big problem.
Absolutely. Darren, your views. There cannot be a specific timeline for going before going live for virtual trading, right?
Correct. Yeah. It depends on what Dhruv just explained. It depends on that particular investor or that institution, at what point they're comfortable to move into live trade.
Thank you. What stop levels were considered before the back tests?
Dhruv can come in. I could.
Yeah, I'll take that one. Yeah, so stop loss is decided by what do you call? We take a distribution of the daily returns for, let's say, last 500 days, and we make a distribution of that those returns and see in what confidence interval the current change in the difference is lying, the price that which we bought and the current price, how in what interval it is lying. If it is something like 95 percentile interval, then we take a stop loss on that. So it's not a fixed, but you can say like stop loss is not fixed, but something like 0.6, 0.7%. In case things go south, we have a hard limit on the broker end itself for the stop loss, which is something like 0.9% or 1% of the portfolio value. So yeah, that's it.
Yeah.
Is machine learning used in all the strategy models, or do you use other kind of models too? They want to know what others, if there are any.
Yeah. I mean, if you looked at it carefully, what you had there in the slides, yes, we do machine learning for sure, but you also have quant models. There's a continuum between quant models, which are the earlier generation but upgraded, and indeed they are very, very. It has got a very good scientific maths and stats basis of it. So we use both of them. My colleagues can answer as well.
Yeah, so I can second that. So yes, we use a lot of machine learning models, but we also have a lot of quant models. For example, HMM is a statistical model. Logistic regression forms the basis of everything. So we have that. So yeah, it's a mixture of lot of quant and ML models. Yeah.
Does Optiris write their own machine learning algorithms, or do you use open source models as well?
No, so we use these open source packages in Python when we develop our models, scikit-learn and TensorFlow packages. But again, the tuning of the hyperparameters is a model to model. It varies and also varies from strategy to strategy. Yeah.
I also want to point out, for each model, there is a separate researcher in a way. For instance, one person is very strong in hidden Markov model, and that is Christina. She does only that. Or my colleague Hitesh from IIT Kanpur specializes entirely right now in what you call logistic regression, nonlinear logistic regression, and SVM, and Sharda specializes in the other areas which were listed there, various random forest as well as ANN models. And Dhruv is a star trader. He is in the front line. He also participates in this model. So we've got different skill sets brought into this.
Thanks, Professor. Do you have an AIML model to read through financial statements in conference call transcripts? Have you been able to develop any?
Yeah, so basically how from where we are getting the news data is another firm called Ravenback. Okay, so we don't have to go through the, we don't have to do the thing, reading the financial statements and converting, using a model and convert them into sentiment scores and all. They do that, and we simply use their processing power and all. So there's no point in reinventing the wheel. Someone is already doing that for us, so we take their outputs for that.
Exactly. Just to add to what Dhruv was saying, so basically we leave the NLP part for the experts. We use the processed sentiment scores that we get from the top data providers, and that is what we then use to compute our features, apply our logics, and then generate our piece.
Yeah, I also want to add to that. I think that's a relevant question in the sense that there are a number of organizations and people, if you like, specialists who do read financial statement and thereby specialize in one or two well-known assets like Apple or Amazon, and having read the statement, etc., make particular or many others in SP 500 that they make a take a view and can predict whether it's positive, negative. And indeed, they work very well, but it's very narrow. And of course, being less is more, being narrow, they get good payback. But ours is wider because we want to take it to different indices. All that we are doing, our real win is focused towards taking it to multiple markets and multiple indices. So we don't do just that particular time. I'm sure you can do that and get good value.
How much capital can your strategies absorb without distorting backtesting results? That's a question. Let's take it. Shraddha?
I think Prof. Dhruv would be best.
Okay, let me come in on that.
Sure.
It really depends. TV designer, the TRADETRON, the really good entry level is about 10 lakhs. If the people from outside India would not know, that is 10 to the power 7, I think, not 8 INR, because of INR. And in dollar terms, it could be at least $50,000 upwards, something like that. Because of the E-micro, we can more or less start managing it. There's a lumpiness of the contract. Dhruv, what do you think?
Yeah, so basically, it depends on the strategy itself. If it's a multiple asset strategy where we have lot sizes and futures, we cannot trade with 5 lakhs or 6 lakh because we will not be able to take the position, and our SSG depends upon the diversification and the tail risk reduction. So if you are going for a multiple asset strategy, you might need something like 25 lakh, 20 lakh INR, right? And if you are going for an index future strategy, you can go, you can run the base strategy with one lot of futures only, and you can scale it up as much money as you have in your pocket. So yeah.
Actually, I want to point out about the last one, SYS-VIX-E-MINI, that it is only applicable. It cannot be applied to the Indian market, mainly because although there is an India VIX, it's not traded at all liquid enough. So you have to apply it in those markets where liquid trading of VIX takes place. And that happens for the SP 500 and also in the European market of V stocks. So we have actually backtested it. We didn't talk about it. It works.
And how often does Optiris deploy new strategies, and how many have you got under your sleeves, profitable strategies under your sleeves now?
my colleague, oh, it costs so much time that is not just money. And talent, time of talent, talented people to get where we are. I mean, where we are with just these three strategies has taken us at least 3 to 4 years. Doing it, failing, going to the client again coming back to us. And given that, I think at the moment we want to sharpen these three. We have a couple of others, actually one more that again by client request we have been on commodities, and that's for China, for our Chinese client. But I think that's about it really. What would my colleagues say? Sharda?
Yeah, so yeah, like Prof said, it takes a lot of time and effort and a lot of sweat and blood goes into creating these models. And but again, once we have something working for one index, it's like comparatively easier to try it on a different index because we set the backbone in one, which is why we said because we have our gap strategy working well in Nifty, we are now implementing it for SP500 and we are already in our backtest phase. So that's how we do it. Yeah, that's my 2 cents in
That's a
this.
very good point. Actually, one thing I did want to mention, SP500 or America is the biggest market. There's no doubt about it. And the open people from different parts of the world can come. VIX and SP500 are traded 23 hours, 45 minutes every day and in trillions. Now, we have an advantage in the SP500 and VIX market. We have the stock with data, because stock with data is very rich. And that's what we really explore very well. So, and it's a shame that the same is not repeated in, say, in the European market. Anyway, that's my comment about it. Darren, you can come in.
Yeah, I mean, obviously the US market is big and there's a lot of interesting sources of social sentiment. As Drew pointed out, there are many different sentiment models and creations, and there's been a lot of innovation in that in the last, even just I would say handful of years. And the traffic is ridiculous in the last couple of months. I just saw a report and things like stock twits have doubled in the last year, and even just in the last couple of months had huge surges in activity. So what's interesting to me about the models that OptiRisk has built is that they are able to handle this massive increase in noise and figure out what is important out of that, what signals are coming out of that new corpus. So I feel like it's a huge, hard problem to solve, and if OptiRisk has managed to boil it down, that's a big value.
Yeah, I see a question. Sorry, will you read out the top question?
Sure, please go ahead.
Have you considered applying such strategy in retail trading platforms as MetaTrader, NinjaTrader? Interesting. First of all, Gaston, you should tell us about these two retail trading platforms. We have been, actually the TRADETRON people approached us, and I'm glad they did, because the best part of it is you don't have to spend like weeks and months in writing out contracts with people. You simply, the way it works, we give a percentage of the money charged, 20% to the TRADETRON platform. And so if MetaTrader and NinjaTrader have some simple way of doing connecting, fine. Because as we said, after 1 or 2 webinars, we won 100 clients in TRADETRON and live ones, and they're very happy. So yes, Gaston, you can tell us afterwards.
MetaTrader, NinjaTrader, we are welcome to know more about other retail trading platforms. Please feel free to write to us.
Are they in the US market? Darren, do you know about them?
No, I'm not familiar with those. Those are oriented towards the retail traders, and my focus has typically been with the institutionals.
Absolutely. Is there a version of VIX strategy for traceable assets in the Indian markets? Professor Mitra, you did something on VIX, yeah?
No. There's no way, because although there is a VIX there in the sense that it is computed in value, so it is useful in doing our AI and ML models, it's just not liquid enough, and there is very little. So that's it. We cannot use VIX in the model. Now, it is possible people can have proxies for VIX using various options, put and call, but that's too much work. We are not into that. That's my take.
Continuing on VIX, the third strategy, 32% of drawdown looks high. Could we optimize this drawdown? Like ATR or simple stop loss, would that work?
I believe people, Jitur, you have to come in after me, or unless you want to do it first before me. But my thoughts are, I think this whole stop loss is overplayed. You start up by saying that if you have appetite for drawdown or drop in your portfolio, and we work against that, across that, what I said, loss aversion. So we'd rather not take a trade than have a drawdown. So what Sharda showed, you have seen, there's hardly any kind of very large amount of drawdown. And similarly, what Dhruv had done, didn't quite mention that part of it, that it also uses the flat state, that is staying in cash. So, and then that's why you have a number of flat states over months, when you are not sure of what you're doing. So loss aversion, we prefer loss aversion to just trying to have a stop loss and drawdown.
Yeah, I'm going to jump in on that. I think that's my favorite part about the OptiRisk platform, is that it has this decision gate that says, when is it important that this signal coming out of the noise of social media should be acted on? And that's a crucial point, because anyone who's spent time inside this world of social media, it's so noisy. And so that, I think that's the key insight, because I've seen these strategies for years, and I worked with some sell side prop desks back when those were a thing, at Goldman and other firms. And that was the key problem, was understanding when it was important to use the information. And so I feel like that gate is the key insight that OptiRisk is allowing you to do. And it's okay to sit for a few days and not do anything and wait until you have something important.
Just in addition to Prof's and Darren's point, yeah, our model is pretty flexible, and you tell us like what's your limit of drawdown. Like you want drawdown to be something like 20% maximum. We can make changes in our models and bring the drawdown down, but that will be a trade-off between the returns then. So that depends on the investor itself. What is more important to him, higher returns or lower drawdown? So yeah.
Next one's for Shraddha. Was regime sensitivity explored in the backtest, Shraddha, in our gap up and gap down strategy?
Well, I can start on this answer, and I don't know if Dhruv would like to come in later. So our models, our training and testing of models are always in a rolling window. So we do, we look like a given period backwards when we make our predictions. So since it's a rolling window, we do go through multiple regimes, and I guess the backtest, the duration of the backtest that we've shown here, it covers both the COVID fall, the unexpected huge drop, and also a reasonably stable period. So, but yeah, that's my answer for this. I don't know if anybody wants to add something.
I suppose only one answer about regime sensitivity is that although we use model for what's called regime switching or regime identification, by HMM, by my colleague, Dr. Christina Elvin Sayre. The methods are the same, but it's used for short-term market movement. You know, that means, as you saw, 1 day or 5 day. So, you know, there is no question of sensitivity in that sense. Okay.
We are already
Gaston,
10 minutes over time. We've got last few questions taking up. I hope the panel is okay with it.
Yeah, fine. I mean, I'm fine because we have to maybe another 15 minutes we can go. If the audience is engaged, we don't mind engaging. But we are learning a few things from the questions, if you like. It's a two-way process. So
absolutely. Next ones, have you already tested these strategies live? I'm not sure which strategy you are referring to, Gaston, here, or these are just backtest results. Generally,
we said we were on gap up, gap down live. We were again for the multi-asset one by Drew. We were trading again. Client came back, wanted a sort of resetting of how much they want to invest. So we are at that stage, and I explained the one with SYS-VIX-E-MINI. So they are switching in between, if you like, backtest, learning, going virtual trading, actual trading back to backtest.
Next is an interesting question. I'm not sure where Mr. Anonymous is from, but are American markets easier to run strategies or the Indian ones? And do more algo traders make it harder to make money for other algo traders like us?
Well, Joop can come in. Sardar, you might make a comment. I'll make the last comment.
Actually, I don't have a good answer for this. Like, there's nothing like comparison being easier or harder. They're like now the platforms are really easy to use, just like Apple laptops. So everything is pretty easy to run your strategy and do the trading right into 2021 because of so many digital platforms are out there. Do more algo traders make it harder to make money for other algo traders like you? Well, it's a fight between algorithm versus algorithm. So if your game is stronger than the others, you'll win. Simple as that. It's a battle royale. So yeah, I hope that answers the question.
Yeah, hey, I'll jump in on that with just a longer term perspective about, you know, does trading, is it a zero sum game? And obviously at the end game, you can think about it like that. But with the emergence of social media being such a driver of the market, we actually need many traders. We need people to provide the liquidity. We need other people to confirm our trades. You know, if you have a view and your model has a view, but nobody else believes you to trade in that direction, doesn't matter if you're right, if nobody ever believes you. You need other participants in the market to get on board. And so actually, I feel like the emergence of social media and the tools to actually trade on it are helpful to everybody involved, because as you see, you push the price in the direction that the models are indicating. So I think there's actually more upside for everybody because there are more participants.
Okay, my comment is that first of all, what we are doing is not what's traditionally known as algo trading, that is intraday or high frequency or ultra high frequency trading. We are doing what I said right at the beginning, called systematic trading. Although it is done through algorithms, it is one trade a day. So daily trading, that's the most important part. Yes, if we can move into, and indeed we want to intraday trading, then that's another story. So that's the first part. Secondly, I think that question, what we have learned, is more about what brokers we use. If the broker is savvy, can take if you like, automated trading instructions using what is called financial XML, FML, then fine, or even their own API. They don't care about the standard. So that is one of the difficult part of it. And most of the big brokers, like interactive brokers, with whom we trade a lot, and ex-ante, they operate in multiple markets. So in that sense, the American market is easier. Actually, that's one of the difficulties. Some of these brokers do not operate in the Indian market, like ex-ante. It all depends on the broker.
I see a few questions from Sergio. We'd be taking last 3 questions. Please upvote the ones that you'd want us to address. Next one is how to keep track of each strategy and ensure things don't break when a module is changed. Which platform do you recommend to make changes?
I think it's far too detailed. Yes, Shraddha, come in.
I'm not very clear about the question, but I can just give an answer based on what I've understood. So whenever we change a module, say enhance something, improve our models, we make sure it's perfect. It's extensively back tested through and through, like we had done the first time. And I'm not sure what you mean by a platform to manage changes. If you're talking about version control, we use GitHub Teams. So we have one for our company. I guess that's the answer I have for this question.
I can just to add on to, so for example, you still have modules for Python 2.7, which is like ruled out right now since 3.5. So pip is one of a good version control, package version control system, you can say. So if we are using, for example, if we are using some Python version and some particular package version, a module version, so we generally freeze it and keep using it unless like it's like really ruled out, like it's really legacy code, which happens very rarely in coding. So that you might not face this problem. About which platform do you recommend? Like R has very horrible package control system. Python is very mature and very easy to make these changes and freeze them, the package module versions. So I think that's what you were asking.
Yeah. Okay, let me come in on that one. It's quite important. Actually, we have in the background at least 2 or 3 persons working on, if you like, turning into and testing the code and making it productizing. Meaning, although we are running in the front, what Shraddha and Dhruv are doing, it's being on the background. We have got 2 a CTO and another technical supremo. CTO is Christian Valente, who is constantly, adopting this code and looking to good practices and so forth. For instance, you have a massive move from R, which cannot be regularly, if you like, supported from software for engineering point of view to Python. That's why it is. So it's a kind of, what's known as DevOps in software system, meaning development and operational release, So we're going through those.
We get that. We have already answered this question and the next one by Sergio. Did my team put up any other question? How to subscribe to the strategy on TRADETRON?
Shay, you can answer, but also before you answer that, I want to make a point. TRADETRON also operates not only in the Indian market, they also operate in the US market. So you can go to them And because it takes long time to build up relationship, I would rather you went through them, and we have an excellent relationship. Shrey and Dhruv answered that question.
Absolutely, it's very easy. You just go to the TRADETRON platform, create an account. We have a strategy code that is 141147. You hit that, search for it. That'll take you to our strategy, and you click on the subscribe button, you'll be subscribed. Or you look for Optorisk, search Optorisk, Nifty Futures Live, Optorisk space Nifty Futures Live. That's the name of our strategy. You could go on TRADETRON's platform, look for that strategy, and you'd get it. Taking up the next question, how can a retail trader start benefiting from the strategy?
Yeah, I'll take that question by investing money in our strategy. Right.
Good answer.
A person having 10 lakhs to invest, who should he contact to start trading with a strategy? Us. You can write to us at feedback@optorisk-systems.com. It's a very easy way to connect with us, and we'd help you subscribe to the strategy. Are you using a Kelly criteria in optimizing your portfolio weights for the trade executed?
I can comment on that one. Yes. About until 2 or 3 years ago, I used to give lectures on Kelly strategy, how we are adopting it. Now, Kelly strategy is a very involved but very clever mathematical way of making sure you make a balance between the cash and the risky asset to which you are exposed. Now, we have simplified it, and we call it money management, as Dhruv explained. And it actually, there have been papers. There is a whole book on Kelly strategy about a tome by various people who have edited it. And the leading paper in that, one of the leading as far as we're concerned, in that by my friend Professor Mike Dempster from Oxford, is about what's known as fixed mix. A simplified version is simply that you take a ratio of the mark-to-market value of the portfolio, and when Dhruv said 30% money management, what he meant is you always put 30% of that mark-to-market value in cash. If it is not been there, if you like, you make trades to make 30% of it is cash. So yes, the answer is yes. We use a simplified version of Kelly strategy, which is can be called fixed mix.
Thanks, Professor. Last 2 questions. What is the minimum investment needed to become your client? It's again depends on the strategy to strategy. Nifty from TRADETRON, you could start trading with 1 lot of Nifty. Dhruv?
Yeah, so that depends from strategy to strategy and market to market. The most basic strategy which you can subscribe to or invest into is the gap up, gap down strategy, which trades just index futures, and that also just 1 lot of index futures. So in case of Nifty, Nifty 50, 1 lot of index future costs around 3 lakh INR. And if you want to trade in SP 500 futures, 1 lot of E micro is around $20,000. So this is the minimum which you can invest into.
The next up, what fundamental data source would you recommend? It's US and European stocks.
Oh God.
Bloomberg.
Okay. Yeah, Darren, you comment.
Yeah, I would say it depends on what format you wanted. If you need a visualization, there are like dozens of emerging free tools out there. Pick the one that you like the best. But if you want, solid fundamental data, your good old Bloomberg terminal is obviously the gold standard because it includes everything. But I would say that the explosion of new financial tools that's out there, I can't even keep up. So it really depends on your use case, whether you want the news or not the news, or just the numbers, whether you want to be able to play with the numbers in some sort of a spreadsheet. You just have to do your research, because there's a lot of innovation, which is great.
Yeah, I mean, our experience is that we need to put a lot of effort in locating the data source. And it's a moving feast, because an organization with whom you had a relationship, say 5 years ago, 7, 10 years ago, they move, they sell their business to somebody else. And as a result, relationship changes, the data source, the price, how we do it. And new data sources are coming up. That's why there is this explosion in alternative data, where they provide you all the data under one roof if you want to. So the answer is we cannot answer that. It's just needs research.
Yep.
And making up relationship.
I said that would be the last question, but one more has come up. We'd just take this and we'd wrap. How do you make sure that your models are not overfitting and the models would work over the next year?
Okay, I can come in here. So that's the entire task we have, to train our models to prevent overfitting. And I guess it's the war between bias and variance that's always there in machine learning. And that's how we train our models. We make sure it's not overfitting. The train and the test set have similar results when tested out of sample. And how do we know it's still going to work the next year? So we are always closely monitoring our results. It's not like we, once done, we don't just let it run on its own. We are constantly monitoring. And also, like I said, we have rolling windows, so we don't have a fixed a train set. It's not like we've trained it and now it's only running out of sample. It's not that way. Our training window keeps rolling, so we're always training our data, training our models up to as current data as possible. So it learns up to what's happened very recently in the market, and then we make our predictions so that the model is very up to date to the current market movements.
This has been a very engaging session. Another question has come up on screen. I know my team has been prompting me that there are several others in waiting. We'll just take this one again. I'm sorry, I've been extending
Other questions,
for really long.
May I suggest that other questions, if they send it by email, we'll give the answers and send back. But on this one, I'll first take it, and then my colleagues who are really trading, predicting and trading, will finish it off the answer. So my point is that, you see, we bring in human judgment not only at the time of deciding what will happen next day, but also the trading is observed or manually, if you like, managed the next day. So at the opening of the market, the prices are quite volatile. And during the up to first and second hour, you see how the market moves. And then, in this case, who deals with it takes a view and wishes to exit or doesn't want to exit. So that's what it is, that by 2 hours from the time of market opening, you have to take a call, because our objective is to be holding cash at the close, before the close of the day, so that we can take a position next day. Joe, you come in.
Yeah, so it's not a hard thing that at 11 a.m. At 11 a.m. we'll be liquidating or dissolving the position, or basically exit the market. Sometimes what happens, we reach our profit target, like we take the position at the close of the market, and next day what happens, like at 10 a.m. we are already making some 2% profit. So we'll just book the profit. Why to risk or be greedy till 11 a.m. and wait? We have good profit around 2%. We just book it. So sometimes we take that kind of manual call. Otherwise, we wait. As Prof said, like market is pretty volatile, and during first 1 hour, you can say, and after that, market kind of stabilizes, and we see. In terms of time zones, the time zone is IST for Nifty 50, and I think Eastern time for SP 500, and yeah, it's not 2 hours for Eastern time for SP 500. Market closes at 4 p.m. NYSE and opens at around 9 next day. So yeah.
Well, I think we've reached the end of the time, everybody.
I hope that
think
answers
it's appropriate that we close it off. And so thank you, everyone, for joining and asking the great questions. And thanks to the OptiRisk team. This has been a very global event. I think we've got people near the Himalayas. I think we've got some people in the Alps. I've got the Rocky Mountains behind me here in Colorado. So for those of you going to bed, have a great evening. And for those of us who are just starting our days, have a cup of coffee. And as Gautam said, feel free to reach out to the OptiRisk folks directly on their website. Just search for OptiRisk, you can find us, and we'll be happy to follow up with you with further questions. So with that, thank you very much, everybody. Good job.
And thank you, Darren, for moderating it, and thank you for the team who worked so hard in the back in recording it. Thanks, my colleagues, and thank you, everybody, and the participants for the very good question.
Final note, the webinar recording will be provided. It will be available on OptiRisk's YouTube channel, Facebook, Twitter, LinkedIn. You could access it there. We'd send you an email, all those who have registered. You'd get this recording by email. You'd be able to download it and view it. Or you could get in touch with us at info@optirisk-systems.com. Thank you. Thank you, everyone.
Thank you.
Thank you.
Thank you.
Yeah.